Hi, this is Kirk with Forex Strategy Secrets, and we're going to be talking about the fear of closing trades. There are several fears associated with closing a trade. It is the same fear for both the winners or winning trades and the losing trades, that you just get all uptight. And the fear of losing big is a fear. Fear of not making enough money, or you think you're going to leave some money on the table. Oh, I didn't get all that was out of there. There was 100 pips in there, and I only took out 50, and it just blows your mind. And that's a fear also. And basic rules to help overcome the fear of loss. Now, these are some things that I have come up with and noticed over the years. Always trade with a stop loss. That way you know what your stop is going to be. You know how far you're going to lose. Don't ever move your stop further away from the place you entered. Now, if you got a few minutes, if you're just still adjusting your stop loss, take profit, that's okay. You just set it so that it's all taken care of. But then you say, well, I'm going to move this out just a little bit. I'm moving it closer. That's the only time you adjust it. Then you need to leave it there and either close the trade manually or let it take you out at your stop. Or if you're not there, of course, it will take you out your stop if it's going against you, or you take profit. So set your stops no more than a 1-to-1 win-loss ratio. Very seldom would you set them to where you're going to lose more on a trade than you will win if it goes against you. Accepting the loss is a part of trading. This is the big thing. Some people think they have to have 100% wins, win every time. If they're at that frame of mind, they're going to not be very successful at trading. You can't win all the time. If you do, then you're leaving a lot of pips on the table, and you're only taking very few trades, and you're not going to make very much money either as compared to what you could make. Trade the odds. Win so many trades for every losing trade. So let's say you are winning, I win 3 out of every 4 trades. You win 2 trades out of every 7. Those are playing the odds, so you know about what you're going to win and lose. When you look at the professional athletes, they know that every time they try to score, no matter which sport it's in, they don't always score. Sometimes they have to try a couple of times. But they know that if they try to score so many times, eventually they will. And so their percentages will be better one day than they are another day. So realize you're going to lose. You're not going to make every basket. You're not going to make every field goal. You're not making a touchdown every time you get the ball. Or you're not going to score in soccer or rugby every time you get the ball. Sometimes you lose and turn it over and have to regroup. So you need to trade the same way on every trade. So develop a style, a pattern, habits, and do the same thing on every trade. If it's not working, make minor adjustments. Pretty soon you'll have a system that works for you, and then you'll have a better chance of being able to come up with your odds. What do I need to do? How many trades do I take that I win, and how many trades do I lose out of those that I take? The basic rules to help you in overcoming the fear of not winning big. We talked about losing. Now this is another fear. People get in trades. I've seen them be in trades, and they're afraid to close them for fear they might lose something, not get every pip that's in the trade, and eventually they end up closing it for like 5 pips profit. And they could have had many pips because they're afraid to close it. They're not trading the same way. They're trading based on emotional skill rather than a mechanical, rules-based skill. Become a steady trader. Accept what the market is willing to give. Now, one day the market's just, you can make all kinds of pips. The next day you're struggling to make pips. But don't get concerned. The market will be open and really friendly some days, and other days it's just throwing a cold shoulder at you, and it doesn't care. It doesn't care whether you're winning or losing. It's going to do what it's going to do. So just accept what's happening that day. When the trade is over, close it. Don't try to think that, well, it'll come back. It'll keep on going. It won't. What if you had the potential of a trade of making 50 pips total? If it had been an ideal trade. Maximum went 75 pips, but the realistic was maybe 50 pips that you could have taken out of that. What if you only took 30 pips out of it? That's still a successful trade. Close the trade. When it's over, get out. Don't expect it to come back. You can luck out sometimes, and it does, and that's a bad thing because then you think it's going to come back every time. Realize that several small wins equal one large win. So you have 5 trades of 10 pips each. That's equivalent to one large trade of 50 pips. Usually the small wins will be more than the small losses. Now that's what you want, your win-loss ratio. You want to win more than you lose, even if it's only you win 3 out of 5 or instead of 3 out of 6. So you're winning. You want to try and keep your wins just a little bit more than your losses, and the small losses will usually be smaller than your small wins. So those two will kind of balance out, or you'll still be in a little bit of profit. But it's what you want to eventually do is consistently trade the same way. You'll get those home runs, and you'll make the big pips, and that's where your account will grow. It all comes down to knowing your averages. Simple but good record keeping. You need to keep track of how many trades you take, how many pips you won. Do it on a daily basis, of course, but a weekly basis is really good. Say, have I improved this week over last? What was the market doing? Yes, I took so many trades, and my percentages are still the same. They're good. Okay, that was successful. But know what your averages are. You have to know where you have been and where you are to project where you have the potential to go. Now we're going to go look at some charts. I've told you some fears and told you very simple things and ways to overcome those fears by being mechanical, consistent, and steady, and being able to accept a loss. Then you can accept a loss and go on. Pick out some good trade setups, and then show what it looks like to have steady, consistent growth in your trading account if you're steadily taking trades. We will also introduce you to a trading tool that will help you become steady in the consistent growth. And that tool is the Norwood Strategy Scanner. Some of you already know about it, but that is such a powerful tool. It's becoming stronger every day as we are uncovering the potential. So we're going to go to the charts now. Okay, here's the nth degree course material with the scanner indicators on them. There are 3 indicators at the bottom. The bottom one is called a filter, and that is put on there because many times the other indicators will say yes, go, 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 but the filter says the move's over. And so that's why they're all there. That's an improvement that we've come up with. So we talked about in the past a 3-bar trade, but today we're going to introduce you to the 4-bar setup. So you pick a larger time frame. We're going to use the 1 hour, 30, and 15 as the time frames. And of course, this is obvious, the news announcements on the pound. But I'm going to look right here. That one turned red. That's a short signal. This one was red. This one was red, and this one was red also. That's called a 4-bar. You have 4 momentum indicators, all giving you the same direction. That's on a 1 hour time frame. Let's look at it again on a little bit further down the road. Right there, it did a retracement, and right towards the end of this bar, it became a 4-bar. So even if you'd looked at the following bar, they're still good for that little trend right there. Now that's on the larger time frame. If you were using a 4 hour, it would look different, and you would trade it exactly the same way, but it would just be on a different time frame. Now we need is what the ideal is, and we have strategies set up like this. It's called a 4-bar, 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 or 3 4-bars is what it actually is titled. And that means you got a 4-bar there. The next time frame has to be 4 bars as well. This one's 4-bar, this one's not. So look what happens. We need to move that over and wait. The scanner will not give you the signal until that's a 4-bar. Now all the things I'm showing you can be done manually. The benefit of the scanner is it brings it to your attention and can cover all of the currency pairs, all of the time frames, and it brings things to you when they're ready, not you having to go through all the 3 time frames every a few minutes to catch them. So we're doing 2 entry points at the same time right now, and the same rules. Now we go to the 15. What does it have to have? It has to have 4 bars also. 1. That one I can't tell if that's a 4-bar or not. it's above. Okay, it's below the previous one, so it would be red, and so that would be a 4-bar entry signal. So someplace right in there, maybe you say, well, I want to wait until it breaks that fractal. That fractals are marking support and resistance, so if it breaks that resistance level right in here, then I want to take that trade and go for a few pips. Okay, so that is how that trade would be set up. You can wait and find them, or you can have the scanner bring it to your attention. Okay, now let's go to the next one. We will start right at the 1 hour, and of course it was red, and then we had to move it over until this was a 4-bar. And then we go to the 15-minute, what it looked like as far as an entry. There's an entry right there, and that wasn't as big a trade before it had this retracement, but we're going to show you another concept about consistently managing your trades. Now, we took both these trades, let's say we took both these trades, and we are going to manage them, and let's look at different time frames to manage them on. On this one is the 15-minute, let's say we entered it right here. Let's say we entered it right there on this one, and this one we entered someplace right in there. So those are the two places we entered those trades. Now, is one of the exit signals that I'm really starting to think is the most powerful exit signal I've seen, but I'm going to show you a couple of others first before I get to that one. When this indicator changes colors, that's an exit signal. So right in here would be an exit signal. So I'll put a vertical line on that exit signal. And then I'm going to put an exit signal on this one. It changed color, so someplace in there. So this one didn't really give you a lot of pips. So we're right in here as an exit signal, and possibly right here on this white line and the cross of the white and the blue line. That would be an exit signal. So that was the small trade, if that's how you manage that trade. Well, can you get back in? Yes, there's another entry signal right there. And there's another one right there. So if you've gotten in this one, a little retracement, you've got another signal in this one, it's still a pretty good move. Now, let's do something. We found the trend on the 1 hour, we confirmed it on the 30-minute, and the 15-minute is where we entered. We can manage it on the 15-minute, but let's manage it on the 30-minute and see if there's any difference in the potential outcome. This one would have been very similar. Might have been a few less on the 30-minute on the pips. On this one, it possibly still would have taken us out if we were waiting this color change, because it opened, went up, and changed colors, so it actually probably would have given us less pips than on the smaller time frame. Okay, now I'm going to show you the other, this has really been my favorite, and so it's my second favorite now, is when the filter crosses back above, or back on the opposite side of the zero line from where you took the trade. We took the trade and it was below, and things were moving, and then when it went back up, so it would have closed us out about the same price. So that one didn't, either exit signal gave us about the same number of pips. If this one right here, it actually happened to be changed colors here at the time it crossed there. But let's look at this 30-minute. 30-minute still would have taken us out about in the same area. So that one, you're not going to change your outcome very much by changing exit signals. Right here, we entered the trade right there, and we waited till on this 30-minute till it crossed back above the zero line. So now let's move it right there. So you rode through all this, and so from this entry point down to right in here, you made about 67 pips versus a potential of maybe 15 pips. And that's by managing on the middle time frame and not the smaller time frame. If you'd managed on the middle time frame on both these trades, there would have been the same amount of pips here, close, many more here. If you'd used this as an exit signal on the filter, that would have been a much larger amount of pips.